Hi, my name is Hazel Haidome and I work with the Investment Research team at Sigma Pensions. Today we're going to talk about the top investment mistakes to avoid. Number 1, avoid taking investment advice from non-investment professionals. Knowing about medicine doesn't make you a doctor. Similarly, the fact that your friend can easily Google bits of details about investment doesn't make him or her an investment professional. It's best that you rely on the investment recommendation of a professional investment advisor before you make an investment decision. The fact that a company is popular doesn't mean that it's a good investment. In such a situation, it's best to rely on the investment recommendation of a professional investment advisor to be able to determine whether or not there is value to be realized from investing in such a company. Number 2, avoid investing in an asset class without understanding its characteristics. Recently, there was the whole trend of people investing in cryptocurrencies and a lot of people got burnt. For example, an investor that's overly concerned about his risk should not have too many equities in his portfolio. It is necessary for a potential investor to do some research to understand the risk and return characteristics of the asset he's considering investing in before he does so. Number 3, avoid making emotional investments. As humans, we have the tendency to be biased towards certain companies because we work there, or our friends work there, or our spouse or our parent works there. And because of that, we feel like we're absolutely sure about that company. Investors must, however, remain focused on the value potential and not be distracted by our personal sentiments. Number 4, avoid having concentrated investments. While every investment asset has some level of risk, some more than others, the magic button to reducing investment risk is the principle of diversification. For instance, a bank executive might have tons of shares in the bank he works in. The worst case scenario in this case is that the bank fails, he loses his job, and the value of his investment goes to little or nothing. It is therefore necessary to include various assets within one's portfolio. The choice of what to include in one's portfolio should not be random. It requires thorough research and the consultation of an investment professional. Number 5, avoid any investment that has no underlying value. While this one is pretty simple, it requires discipline so as not to get caught up in greed. The value of a stock is determined by the present value of its cash flows. The value of a bond is determined by its interest rates. While there are a number of non-traditional investment options, one must be wary of any asset whose value source cannot be traced. It is much better to lose out on an investment opportunity due to thorough due diligence than to lose your money to a fraud.